It's another weekly webinar session for us at Pips O'Clock. And today we are looking at another very interesting topic, mastering market structure, the foundation of successful trading. Mastery market structure, the foundation of successful trading. If at any point you can't hear me very clearly, please let me know. I would like to get us started quickly. We have our Forex coach here, Mr. Ifeanyi Uche. Mr. Ifeanyi is an experienced Forex coach. He's a trader himself and has been in the game for many years. But before he gets us started today, this series of webinar is hosted by Pips O'Clock. Pips O'Clock is a community of Forex traders. We help our community members to become more successful with their trading. We do this by providing training, by providing also educational webinars like this, and also by providing the weekly market analysis and the news review. So if you are not a full member of Pips O'Clock, that is, you usually do not log into the Pips O'Clock member area, I want to invite you to log in and be a part of it, because there are a lot of resources that can help you to become a better and more profitable trader. So today we are considering another topic, and Mr. Ifeanyi will get us started with that topic for today. I also want to remind you that we do this every Thursday by 12 p.m. So please always look out for the invite. You can also log into the Pips O'Clock member area to register for upcoming sessions. Once you register, you get an email. The email will contain the details for you to be a part of the session. So it will contain the Zoom link or whatever link we'll be using, and all the access information that you need to be a part of this session. So today, to get us started, I want to invite Mr. Ifeanyi Uche to present and take us through the topic for today. Please stay to the end of the session so that you can have an opportunity to also ask whatever questions you might have. You are all welcome, and please enjoy the session. Mr. Ifeanyi, you have the floor now.
All right. Okay. Good afternoon, everybody. Thank you very much, Lekon. All right. Do I have the right to share?
Yes, sir, you can share.
Okay. I believe everybody is hearing me. If you can hear my voice and see my screen, let my screen show, then you can confirm both together. Okay. So if you can hear my voice and see my screen, could you just give me a Y in the chat? You can hear my voice and see my screen. Give me a Y in the chat, please. Okay. Thank you. Thank you. I can see that. Thank you very much. All right. So you're all welcome again. Thank you very much for showing up. How are you? Not here. Okay. So today we are looking at a very interesting subject that when you come to trading, many traders can actually operate in the markets for years without even understanding this concept or subject we're about to discuss today. And many who were told about it or heard about it or read about it or took some lesson on it, some still find it difficult to. And it's not difficult if you just understand it. So what this presentation will do today is to expose you to what it is. Perhaps you still are oblivious of it, of its existence, or maybe you've heard about it and you don't really understand what it is. So this session will help to open your eyes to what it is, and then give you a guide as to understanding it. And then you then go more like, let's lay a foundation so that you now go and build on that foundation. Because once you have a good foundation, it's easy to now need to lay the building blocks on it. And that's what we aim to achieve with our Thursday webinars. So today will not be an exception. So at the end of the day, I believe that we'll have an understanding of what market structure is, and then we'll go on to master it, because that is the foundation of successful trading. So we are more like, just see like you are going to be unlocking the key concepts to gain an edge in the market. Because once you have this, you're able to have an edge in the markets. Not have an edge over your friends or over other traders, but have an edge in the markets. Okay. All right. So quickly, let's go on to. All right. Good afternoon. So Just pay attention, please. All right, so now let's go on to the main lesson. The introduction, what is market structure? That's a big question. What is market structure? When you come into the market, you heard about price action. Price action forms the charts, whether you are using line charts or bar charts or candlesticks. Price action over time form those charts. Okay. Now, after those charts have been formed, whether they are candlestick charts, line charts, or bar charts, they have a certain arrangement. They have a certain organization over time. So that means you can now look back in the past, because when you talk about technical analysis, you are talking about historical examination, evaluation of what has happened in the market with a view to using the information you gathered, use that data, form your information, and use it to make a decision as to what to do next. All right, so market structure, understanding it helps you to see this arrangement. As soon as you look at the chart, you see the arrangement. You know what's up, what has happened. You have an idea of what may likely happen next, because everything we do here is under probability. We go for trades that give us higher probability of winning. So market structure also defines how the market moves, how the market shifts, and how trends also occur, form, move, and even decline, and providing us with kind of context for making the right trading decisions. And so when you understand market structure, it helps to form a strong foundation for your technical analysis. And it's important for you as a trader, because one, when you understand market structure, you'll be able to understand market trends. You'll be able to understand where the reversals might occur. You're able to understand your optimal entry and exit points or levels. And understanding and implementing your knowledge of market structure also helps to reduce emotional trading. How? Because it helps to provide you with a framework, a very clear framework to work with. So that when you just look at it, like, okay, well, this market is tanking, let me stay away. Or this market, though bullish, I see that it's about to start distributing. Okay, so let's get down to the components of market structure. Now, there are three main components of market structure. You talk about the trends, you talk about support and resistance, and then you talk about market cycles. Trends, support and resistance, and market cycles. These are the three main components of market structure. So understand it. When we talk about market structure, there are three main components that form market structure. We talk about the trends, you talk about the support and resistance, you talk about the cycle. So pick them one after the other. All right. And then in this very slide now, we'll just talk about them, mention them, and then as we go deeper, we'll begin to explain them one by one. Now look at uptrends. When you talk about trends, you have uptrend, you have downtrend, you have sideways in or range bound markets. In an uptrend, you are looking at a series of higher highs and higher lows. The market has a series of higher highs and higher lows. For example, today is Thursday already. Let's take, for example, this week so far. Let's look at maybe an instrument like GBP USD. So let's say that the high for GBP USD on Monday was 1.35, and then the low was 1.301, and then what's it called now? So now you come on Tuesday, you have a high that is 1.36, and a low that is 1.31. And then you come on Wednesday and you have a high that is 1.37, and then a low that is 1.33. Okay, now today is Thursday. You want to use the information that happened, information you gathered based on what happened on Monday, Tuesday, Wednesday, to make a decision for today. Now, if you look at Monday, Tuesday, Monday has a higher high because the high of Monday, Tuesday has a higher high than Monday because the high of Monday was 1.3. The high of Tuesday was 1.36, so it has a higher high. Then the high of Wednesday is higher than that of Tuesday because Wednesday has 1.37, while Tuesday has 1.36. So Wednesday has a higher high than Tuesday. Tuesday has a higher high than Monday. Now, when you look at the low also, the low of Monday 1.30, while the low of Tuesday is 1.31. So it means that Tuesday has a low that is higher than that of Monday. So it has a higher low, all right? While Wednesday's low is 1.33. So Wednesday has a higher low than Tuesday. So you now have a market that has series of higher highs and higher lows, and that is an uptrend market. But then conversely, you may say you have Monday 1.35, then you have Tuesday for high, you have Tuesday high at 1.34, you have Wednesday at 1.33. And then the low of Monday 1.30, well, on Tuesday has 1.29, and then Wednesday 1.27. So in this case, you have Monday's high is higher than that of Tuesday. So you have lower high, and then the low of Tuesday is lower than that of Wednesday. You have lower low than that of Monday. So you have lower low. So and continue like that to Wednesday. Wednesday's low, Wednesday's high rather lower than Tuesday's high. That means it's a lower high, and the low of Wednesday is lower than that of Tuesday. That means it's a lower low. So that gives you a downtrend. When you have series of higher highs and higher lows, it's an uptrend. Series of lower lows and lower highs is a downtrend. That's the first part of market. And then, but if it's just range bound, yeah, the highs are not really quite noticeable. The lows are not quite noticeable. They're just going sideways, very dull. That is when you call, say the market is in a consolidation mode. That the market is in a consolidation mode. It's in a consolidation mode state. So in that regard, what would you do? Find out. And then you go on to the second component, which is support and resistance. Support and resistance, you have what we call key levels, and key levels are areas where price constantly reacts. Price will always react around the key levels. For example, you have resistance. Let's say, for example, now they talked about the high of Monday being 1.35, and then as price was approaching there on Tuesday, price will react because there it got there and was stopped. And then as price is approaching there on Tuesday, it will also be careful about that because it's going to react. So as traders, you begin to look forward to those areas, resistance areas, support areas, because price will react when it gets to those. And when price reacts, one of two things will happen. Talk about that as we progress. All right. So next, you have the market cycles. You have the accumulation cycle. In the market cycles, they come in phases. There are about 4 phases. And then you have phase 1, which is the accumulation. You have the markup phase. You have the distribution phase, and you have the markdown phase. We're going to be looking at this one after the other. So let's quickly get down to the types of trend. Okay, so types of trend you have, like I just beat them down there a bit. So when you have series of high highs and high lows, is an uptrend, which indicates a bullish market sentiment. So you should be looking for opportunities to buy in an uptrend. While downtrend are formed by series of lower lows and lower highs, and it reflects bearish sentiment. Of course, when you have sideways or range bound markets, price will move between support and resistance levels, and that is a market that has no clear directional bias. And so, such a situation, what should you do? Now, popular advice would be stay away. All right, but there are some that also fly through this kind of markets. Okay, all right. So, but then continue the next support and resistance zones. For support and resistance, let's look at support levels. All of us are sitting down on a device or a chair or on a couch participating in this webinar. So, and your feet are on the floor, ground. That ground where your feet are set on, and they are giving you support, or the ground on which the chair, yes, consolidation, yes. Sideways also consolidation. Now, the ground on which you are sitting or where your chair is sitting is laid on has given you support so that you will not sink. That is just a layman explanation of support. So when price or when you throw a ball up and it drops, it's coming down because of the force of gravity, it bounces on the floor and then rises up. That floor has given it support, preventing it from falling deeper on the ground. While resistance levels are areas where price tends to stop rising and reverse downwards. So supports, areas where the price tends to stop falling and reverse upwards. Resistance, areas where price tends to stop rising and reverse downwards. Now, the key point here is that these levels are, they often lead to breakouts or reversals. That's why I told you I'll tell you about support, one of the things that happen around support and resistance areas. It's either there's a breakout, so that you enter into breakout trading, or there is a reversal. These are one of the two things that happen. You know, it doesn't matter how long price stays at a support or resistance area, one of two things will certainly happen. It's either there is a breakout or there is a reversal, a rejection that will lead to a reversal. Okay, so always take note of that. So as if you are on a trade already, let's say you are bullish on a trade, you have placed a buy and it's going in your favor, your direction. There's a need to have also studied, in fact, before you even place the trade, you should have analyzed the support and resistance levels. In other words, call them key levels. You should have analyzed them to know the distance between where you want to enter and the next support or resistance as you want to buy, between where you're entering and the next resistance. You need to measure it, one, know that distance, and then measure the next distance. Maybe you are entering at the support level, below it, okay, maybe where price action has happened and formed its own support again. Between that place and that below that level, what is the distance also? You cover it. That will be where your risk should be. You know that, and then compare it with where you are targeting and that the next resistance is. That could help to give you your risk-reward ratio to see whether that trade is actually a good one for you. A high probability. After you must have understood or determined the trend of the market. Because when you determine the trend, bringing in support and resistance now makes it easy for you to now determine your risk-reward ratio. Okay, so just take note that at support and resistance levels, one of two things will happen. It's either there's a breakout or there's a price rejection that will lead to reversal. Now let's talk about market cycles. Now here you need to understand the phases in the market. So you have the accumulation phase where the buyers dominate. In an accumulation phase, markets will first consolidate before an upward move. Market first of all consolidates before an upward move. And in fact, when that happens in an accumulation phase, now there's been a decline. Price has been falling for a long time. And then after a while, there's stagnation, which is where that consolidation happens. Then after a while, what that is signaling is that the bear market or the downward trend is over. You know, it has been going down and then it stops and begins to consolidate, stagnation, volume begins to drop. You know, at that point, price becomes stable and begins to move sideways in a range. At this point, only those investors that have insider knowledge or those who have long-term perspectives, you know, what they call smart money, they will begin to buy at low prices, and they are buying at low prices, believing that the asset has been so undervalued that very soon it will start going up. For example, the Oracle of Omaha, Warren Buffett, is said to be known for when stocks are falling, good stocks, and investors are dumping and running away, he begins to buy. That's what he said. He used $100 as a young boy and built it into the multi-billion billionaire he is today, just studying how stocks work and all of that. And eventually he sees it is falling, he gets to a certain level, he knows, okay, this is still falling, leave it. And until he gets to that level when everyone is not so afraid. Because stock traders, when there's a bear market, stock traders there's usually panic and people begin to sell. And those who understand, who have smart money, will begin to use their smart money to get into the market. So that is the accumulation phase. Then The market, the markup phase is when markets begin to now rise, to trend up. Because after that accumulation, then you now have in fact, during accumulation, let me also chip in that during the accumulation phase, volume typically remains low because most traders are pessimistic. I just mentioned that, they're afraid. And the psychological sentiment in an accumulation phase is that market sentiment is very, very pessimistic at that point, typically pessimistic, because traders are hesitant. They are thinking that if I enter the market, the price might fall further. So those who are holding on to their stocks, at that point they might become so afraid that they'll say, well, what if I keep holding it and it becomes it loses its complete value? So they'll sell. And those who have smart money buy. I'll buy, and then the market phase will begin when market begins to trend off little by little, and then it begins to rise. And then you have the distribution phase. At the distribution phase, sellers dominate the market. What it means here is that market has reached its peak, or a peak, and then begins to consolidate. Just the opposite of the accumulation phase. Market begins to price begins to consolidate, and at that point, sellers begin to be careful. Those who have been buying, it's either they're out and then taking profits, and then sellers begin to come in, and as they begin to supply, what happens at that point? Price begins to come down, because the higher the supply, the lower the price. So at that point, from distribution now, price begins to go. Who have been bullish there, they will want to take profit. When they take profit, price will drop, because as they are taking profit, they are selling, begin to dump, release it, and then it saturates the market again, then price will go down. And then those who do not know, is at that point that price is more like at that market phase. That market phase, as it's peaking, that's when excitement comes into the market again. It's bullish market, and then the majority jump in. And when they now jump in, some of them are taken to the slaughter. Some will buy so high. As soon as they buy, they say, why is it whenever I enter, whenever I buy stock, that's when the price begins to crash. Why? Because they don't understand the physics of the market. Why is it that whenever I just buy this asset, it begins to go down? Because you didn't understand the physics of markets. And one thing is that when we have the fear of missing out plays a big role in the market phase. Because the bullish trend, the bulls are back into the market. So you are, if I wait for longer to observe, and I may miss out. Why don't you miss out and be sure you're right? But many traders, majority, will out of FOMO, fear of missing out, hop into the wrong markets. Maybe at that market phase already, it's almost approaching saturation for distribution to set in. And when they get in now, things will be stuck in their hands again. At the end of the day, they will sell again cheap, while the smart money come back down and buy them back cheap. All right, so next is the markdown phase, where price declines, and then at that point, the market is about to enter a bearish trend. But I hope you understand these four phases with this little explanation. You want to go more deeper into it, you want to enroll in one of our courses, perhaps. Understanding market structure shifts. Now, how to understand market structure shifts? You have what they call the break of structure, or POS. Now, when there's a break of structure, it's a signal that a trend may be changing when price breaks beyond the previous low, high, or low. For example, I use the high of Monday, Tuesday, and Wednesday, give you. Now, we say, okay, Monday, in the second scenario I painted, I said Monday had a high of 1.35, Tuesday 1.34, Wednesday 1.33. And you're anticipating that, okay, price may get to 1.33 and then turn back 4, or you may get to 1.34 339 or something, but then it breaks past 33, goes to 34, and then breaks past it. And then, as you know it, as you were watching it, it comes down again. Before you know it now, it breaks past even 35 that happened on Monday. So that structure has been broken based on that. I'm just using that as a scenario. But then when you look at market structure, it's over a period of time. It's not just one particular candle. It's over a period of time. Now, depending on the time frame you set it on, you're able to view it a longer time. Okay. Like one day now, if you're on 1 hour, it will give you plenty of candles or periods. So, excuse me, you also have market structure high and market structure low, MSH and MSL. These are the key turning points. Like I mentioned, Monday, Tuesday, Wednesday highs. They are the key turning points for market direction. So if the trend is sustained, so that means that you can actually say, okay, Monday high was 1.35, so price reaching there was a little above it, that, okay, this thing may be going down. Using on the second scenario I use, Tuesday 1.34, Wednesday 1.33. So you can say, okay, so that point place, the market structure high there can be your turning point, that if price gets to that place, a rejection will signal that you enter to sell, or if price gets to that place, a break will suggest that you buy. If you want to set up your trade, you may count maybe 10 pips ahead and set up a buy stop order, or you can set up at the other point and set up a sell limit order, whichever one happens. Now, when you want to using market structure, there's a need for confirmation. So you need some trend confirmation tools, such as moving averages, trend lines, and these are tools that you don't need to spend a dime to get. They come with your trading platform. Just learn to use them. Learn to use trend lines. Learn to use moving averages. Learn to use Fibonacci, and you'll be good. So once you understand market structure and build it, somebody was chatting me a few days ago, and he wanted to pay for a particular software that will, of course, scan the market and generate signals. And I asked him one simple question: can you cope with this? Count the cost first. Can you cope with paying for the monthly subscription? Because first you pay $150 to start, subsequently you pay $99 every month. Can you cope with that? How much you have in your bank, in your trading account? Will you be able to make the profit that can be paying for this? Count the cost. Or would you just understand these simple tools? They are there with you. Learn to use them, and you don't have to be trading all the time. And cut down your frequency of trading, and you find out that you'll be good. Compared to you spending so much, let's say you have $500 and you're spending $150 the first month, subsequently 100 every month. Are you able to make at least 150 or 200 on 500 in a month? Is that so easy? Now, if you can, then go ahead. So, but with these simple tools, you don't need expensive tools, highly priced tools to actually get that. What you need is education. Give yourself the time to learn it and learn to use it. And that's where, at least when you see signals, you need to know how were these signals generated. So that could help to, give you that understanding, so you'll be able to start doing it yourself. All right. I think I said so much already. So at this point, let me conclude with the questions. Let's look at the mastering market structure for success summary of today. 1, market structure forms the foundation for successful trading. 2, identifying trends, support resistance, and market cycles enables better trading decisions. I believe that you understand that these explanations today. And mastery helps to filter market noise, improving accuracy in trades. So all of you, if you understand this thing, you see that the fear of missing out will disappear. Final thoughts: constant practice. So go ahead and practice these things, study more on them, and perhaps enroll in one of our courses, and we'll have this enter the chat you yourself begin to identify by yourself, and you'll be good. And refine your, keep on refining the market structure analysis, and then as you keep on doing that, you see that your long-term success will be assured. All right, I will draw the curtain at this point and open the floor for questions.
Should we be always looking to buy during accumulation phase? Should we be always looking to buy during accumulation phase?
You look for opportunities to buy in the accumulation phase and look for opportunities to sell. You didn't say always be buying. At that phase, the probability is high that it will start going up. You may buy at that point and it's not yet done. Do you get the point? So you look for, that's why before I close that session, I talked about confirmation, and I gave you 3 tools for confirmation. Do you understand? Accumulation phase, look for opportunities to buy. Distribution phase, look for opportunities to sell. But then you need confirmation. And there are 3 free tools I just gave you, the mention that you can use for confirmation. How to use them, I won't be able to explain them to you in 1 hour in this session. That's why I gave those recommendations.
All right. Thank you for your response. Please, how much is it to learn how to use these trading tools? Okay, I would answer that. Let these videos be available in the YouTube channel. Okay, how to join the VIP group? Okay, so I will answer the other questions. Does any other person have any other question for Mr. Ifeanyi? Any other question? Okay. First, thank you all for being a part of this session. Next week is going to be another session, and next week we'll be looking at another interesting topic, the act of analyzing price action, decoding market movement, the art of analyzing price action, decoding market movement. So it's also going to be the same time, 12 p.m., just like we are having it today. Be a part of that session. One thing you can do to register ahead is to go to the Pips O'Clock member area. Then you go to events, just click there, you would see how to register. Once you register, you immediately get the details to join that session in your email address, in your email inbox. So you can register ahead and be a part of the session next week. So Pips O'Clock is the organizer of this session. And like I shared at the start of this session, we provide forex training, articles, analysis, news reviews within the Pips O'Clock member area. And we hold these weekly webinars. Also, we provide trade signals. We have a mentorship service, and you can benefit from all this. For someone who asked how to be a part of our Signal channel, this month we've started a private VIP Signal and trading room service. And what we do is we have a trading room session every Mondays, Wednesdays, and Fridays. So 3 times a week, we come together and we look at the markets, we look at gold, we look at other currency pairs, and we find trading opportunities. And outside of the trading room session, once there's a signal or a good signal that we can take, the signals is also shared in the private group for us to take it. So we've been on that this week. I know that by the end of the month, we'll have reviews. Members of that private group share their experience with you. And if you want to join, you can still be a part of us. Even though you are joining midway, we would find a way to extend your subscription. So it's not too late to join. You can still join. And the way to join is to go to our website. This is just what I'm displaying to you is just a few statistics about the trading that we've been doing, which led us to having this private VIP Signals group. So if you want to join, just go to our website, go to pipsoclock.com and go to the store. Once you go to the store, you see a link to the private Signals group, and you can pay. The payment right now is discounted. You pay 30,000 naira for the subscription to be a part of the group. And once you pay, what you get is you get an email from us which contains the link for you to join. It contains the link for you to join, And then for you to join the Telegram group where we discuss, and then you'll be able to join the trading room sessions 3 times in a week, and then you can ask questions. And the benefit of the trading room session is you see how trading decisions are taken. So you see how the market is analyzed. You see how trading decisions are taken. The market is analyzed. Then we also analyze news. For example, we analyzed the CPI news. Last Friday also, we analyzed the non-farm payroll news, and we took some trades. We took a trade for the non-farm payroll. We took another trade for the CPI news that came out this week. So you can be a part of it. There's a lot to learn. And by the end of this month, I know that we'll have a cumulative success story to share. So you can be a part of it. Displayed here is the link for you to join. I'll also share the link within this this chat so that you can get it. So that's how to join the VIP group. Also, we have training programs. If you want to learn more, if you are new, you can purchase the Forex Mastery program. This program is for beginners. It's just 60,000 naira. You can get it from our store on the website, pipsoclock.com/store. But if you want to learn more about the different trading strategies and all that, you want to learn more about market structures, market dynamics, Fibonacci retracement strategy, and other indicators and all that, you can purchase the Forex Profit Optimizer course. So this assumes that you have some basic knowledge of Forex trading and you just want to advance your knowledge. So it's just 120,000 naira. And what it comes with is that you are also getting a 6-month mentorship program, and we have a 100% bonus, deposit bonus for you also. So you can take advantage of this also. You might already know that our partners of Skilling. Skilling is a broker that we recommend. I want to believe that you would already have a Skilling account if you have been receiving emails from us. But if you don't, you go to pipsoclock.com/broker/skilling. That's how to get started with Skilling. And why Skilling? Well, they have a superior trading condition, over 900 instruments that you can trade. You can trade crypto, forex pairs, you can trade other commodities and indices. So the spread is competitive from 0.1 and above. Then they have you can trade with the MT4 trading platform, you can trade with the CTrader trading platform, and you can also trade directly on the web. So they are licensed. I believe you know how important that is. They are licensed and regulated. Your funds and personal data are fully secured with Skilling, and then you get leverage of 1 to 1,000, up to 1 to 1,000. There's a welcome bonus. If you've not made any deposit on Skilling before, you can get a $30 welcome bonus on your first deposit of $25 and above. Once you make that deposit, is automated, you'll get a $30 welcome bonus into your trading account. You can trade with the bonus, you can withdraw your profit from the bonus, but you cannot withdraw the bonus itself. There is also an exclusive 100% bonus. If you make a deposit of $50 or $100 into your trading account, you can get an exclusive 100% bonus. If you are not on our Telegram channel, the way to join is to go to t.me/pipsoclock. So that's the way to join our Telegram channel. I believe I've been able to cover some of the questions that was asked. So I've shared now how to join the VIP group. I've also shared what you need to know to learn more about using these trading tools. And if you want like a customized one-on-one training program, we can arrange that with you. You can always send us an email, help@pipsoclock.com, and also send us a chat on WhatsApp. Our WhatsApp number is displayed. I would quickly share that with you again. So our WhatsApp number is 08058146723. So you can get in touch with us with that. Let me quickly get the link for you if you want to still join the VIP group for this month that is already ongoing. You can join us you make a discounted subscription fee of 30,000 naira, and then you will be given the access to join us. So that's the link. Please do join us. Okay, so to get this material, please, what you would do to make it quick and easy, just message us on WhatsApp. Just message us on WhatsApp with the message, I need the material for today's webinar. But we'll make the recording available in the Pips O'Clock member area. But if you need these slides, please just send us a message on WhatsApp. I would have said we'll send it, but then it will mean sending it to even people that don't need it or don't want it. But if you want it, just send us a WhatsApp message. I can copy the WhatsApp number and send it to you right on this chat to make it easier for you. Send us a WhatsApp message and then we'll send it to you. So that's the WhatsApp number. Just click on it, send us a WhatsApp message. I need the slides for today's webinar. We'll send it to you immediately. So thank you so much, everyone, for being a part of today's session. I want to believe that you got value for it. I would want to ask that you make it a routine to be a part of us. It's every week, 12 p.m., same time like this. Maximum 1 hour, we are done. And we treat a lot of very interesting topics. You also get an opportunity to ask questions. So if you don't have any other question, or let me confirm, does anybody have any other question before we go today? If you don't have any question, I hope to see you next week. I hope to see you in the session next week. And I hope that you are trading and that you are making profits. And all right, thank you so much. That will be the end of our session today. Enjoy the rest of today and enjoy your weekend. Bye-bye for now.